Hello, everybody. I'm Ro Pugnani with the Owner's Asset.
Hey everybody, Mark Switaj, also with the owner's asset. We're excited to be together today. I was moving my little fish out of the background out of the way. Um, you'll be asking why I have a fish on the wall. We'll talk about that later. But let's talk about today what it means to be a small business owner. I'm a small business owner. I'm a private investor. My taxes have been too high, and likely so are you. Your taxes are probably too high. Bro, talk to us today about cash balance plans, contributions, pre-tax implications, the exits that they offer, and what we want to accomplish in today's video.
Yeah, it's great to be with you and to get to talk about this topic today, Mark. If you are facing persistent and consistent tax liabilities as a small business owner, there is a tool out there that can dramatically change two things simultaneously for you. First is your current tax picture. As you said, your taxes are too high, mine are too high as well, and it can also change your retirement. So let's link the two. We've already cut a video on what is a cash balance plan. So I want to spend a little more time today talking about the benefits. I'm going to highlight three specific and immediate benefits. The first is if you're a successful business owner, the 23,500 you can put to a 401k and some additional into a profit share isn't going to be enough to replace your lifestyle. So that's the first benefit. A cash balance plan has significantly, massively higher contribution limits than a 401k plus a profit share alone. That's the first benefit, plain and simple. Depending on age and income, those benefits can be as much as 17, 18x that 23,500 amount. In some cases, 20 times that amount. So huge opportunity to pay yourself instead of Uncle Sam. The second is that these contributions are tax deductible. Why is it important? Because we sort of mentioned it in the context of retirement planning. There are lots of benefits out there for business owners to use after-tax dollars that may not be deductible, like Keyman insurance or a 162 plan, etc. These are deductible. So let's just give a quick example. This is a top-line deduction. If your business is making $1 million a year and you contribute $400,000 to a cash balance plan, the IRS says, oh, this business didn't earn Mark's business. Let's use you, Mark, as your repeat business owner, right? Mark's business didn't earn $1 million this year because of this contribution. They only earned 600,000. So massive tax savings. The third thing that we love about cash balance funds from a benefits perspective is I like to call it the elegant exit. There's lots of different ways to sort of disentangle from the plan, right? With a pension, a more traditional, defined benefit plan, it's a set for life. You can choose that option. So you don't lose any of that functionality. You can roll it and create a super IRA. You can distribute some of it out, or you could do in-kind redemptions to move assets from one to another. No one case is ubiquitous across. Each cash balance plan can have its own custom exit. So those are the major benefits, Mark, of a cash balance plan.
Bro, who does this work best for? Like we talked about, I'm a small business owner, repeat founder, entrepreneur, right? What does it mean to be a business owner for cash balance plans? Tell me a little bit about
Yeah, I'm hearing two questions, so let me kind of answer both. Everyone thinks business owner, and they immediately think C-corp or LLC, and this works for both of those. This also works for 1099s. So I don't want you to think, well, oh, this doesn't apply to me because I'm not incorporated via an LLC or some sort of multi-member structure. No, this works for 1099s, right? When everyone understands who it works for, just think about it this way. There is an entire secondary retirement system that exists for the non-W-2 folks out there. Now I said W-2, so now the S-corp folks are saying, well, I get a W-2 from my S-corp. Their W-2 income from your own S-corp counts towards the secondary retirement system, the supplemental retirement system. So yeah, it works pretty much for anybody except a rank and file employee of a C-corp. A C-corp could do a cash balance plan as well if it's smaller in nature, less than 50 employees. It can go higher, but there's some complications there. I think that was the first question that it works for. I think the other thing you asked is who does it work for is, well, it tends to work best for moderate to high income earners who may have done what most people do is defer paying into retirement assets while they're building their business. This is your baby. This is your nest egg. You can play a lot of catch up with this strategy. So yeah, you need to be a consistent, profitable business, and then you can actually, yes, pay yourself and your retirement accounts before you pay Uncle Sam.
Got it. So we talked a little bit about what a plan is, what the pre-tax looks like. Tell me a little bit about what it means to exit. Like that's an interesting phrase, to exit a cash balance plan or exit a plan like this. What does that mean, and what are the implications there?
Yeah, I think savvy entrepreneurs and business owners have, and this is very polarizing, by the way, as a financial advisor, to talk about what I call RMD purgatory, right? Required minimum distribution purgatory. When you put a dollar into a retirement account, you typically pay a penalty if you access it before 59 and a half, right? Or you wait as long as possible till age, I think they just moved it up to age 73 last year or 2 years ago, right? Then you pay as ordinary income. Well, what's so interesting about a cash balance plan is some portions of it can be distributed out on a favorable basis. So one example is life insurance. There's actually one of the few ways you can buy life insurance with pre-tax dollars is inside of a cash balance plan. So if you want the deduction today, but you don't want to leave your money in purgatory, you can choose that exit option. So Mark, that's it. If the plan is say 30 to 40% life insurance, you can pull that out, and now you're not paying taxes on it because it's life insurance, and you do all those other cool benefits of it. Another strategy is to take, you know, the cash balance plan. Let's say you're a 1099, so it's a single person cash balance plan, and you've gotten $300,000 a year worth of deductions because you've been contributing that much, and you've done it for say 5 years. You now have at least 1.5 million of corpus of body of capital in this plan. You just roll it to an IRA. So if you're anti-RMDs, there's some solutions for you there. Or if you like the security blanket that RMDs offer, you can take the whole thing and roll it to an IRA. And what's interesting there about an IRA is, again, back to this business owner entrepreneurial mindset. That IRA, you have a lot more freedom in what to invest in, right? You can self-custody it and do alternatives with it. You can pick your own stocks, etc. You have a lot more freedom in an IRA to control costs and asset allocation, etc. So yeah, the elegant exit phrase is kind of the world is your oyster here.
Cool. So it's neat. What I'm hearing is, pretty significant six-figure deductions on my business, assets within that can be distributed out to my benefit. Um, you know, Maybe talk a little bit about these assets, right? Like when I hear life insurance, I'm sort of familiar with it, but like just high level, like what are these assets that I'm getting out of this?
Sure. And after the life insurance dialogue or the assets dialogue, we should actually talk about implementation because I think clients want to know, okay, how do I do this, right? But the asset mix is really interesting. When you have a traditional 401k, you have a choice of funds, stocks, bonds, cash, right? And there's some recent regulations that have just come out, literally in the last 2 weeks, that you may start to get to alternatives inside of 401ks, which may or may not be a good thing. I think history will be a guide for that. But as I sort of teased out, there's only one or two ways to really buy life insurance with pre-tax dollars, and this is one of them. The implications for that are really interesting. Is one, you get immediate protection. Right, so when it's in a cash balance plan, you get, you write a check for, let's say, $100,000 for the life insurance, where you're getting, 10, 12, 15x multiple there of protection for your family right away, and you're getting a tax deduction to do it. So that's interesting, right? The tax arbitrage is interesting. Let's keep focusing on this $100,000 number. Math is easier on tens. I'm probably not the best with math, even though I'm South Asian, right? And so you have this $100,000. If you were to spend $100,000 on life insurance with after-tax dollars because you saw its benefit, right? You could do things like collateralize it to create your own bank, the estate planning implications, the covered asset strategy, right? Buffering you from volatility in the market. So let's say you've made that decision. Well, this is a really cool way to acquire the asset. Well, if you're going to spend $100,000 on life insurance with after-tax dollars, you would have had to earn about $140,000. But if you buy life insurance in this way, the same $100,000 premium, you're getting a deduction for it. You're spending about $62,000 for the same amount of life insurance. So the question is really simple. Do you want to spend $62,000 for a $100,000 asset, or do you want to spend $140,000 to begin to earn $140,000 and then spend $100 to begin to acquire the asset? So the asset allocation is really interesting, and that is unique to cash balance plans, Mark.
Wow, the swing there that you're talking about of 140 to 60 some odd. I mean, like that's a huge difference, right? Being able to grab these assets with pre-tax dollars.
You talked about your taxes are too high, so are mine. I loved when you said that, Mark. And what's so interesting is higher taxes today represent less future wealth. That's how it's relatable to our clients. So sure, you want to pay less taxes today, so does everybody. But if you're an entrepreneur, you're a wealth builder, every dollar that doesn't go to taxes, you're probably putting towards a productive forward asset. That's where it gets cool. I'm so sorry to cut you off, Mark. Go ahead.
Yeah, that's right. I mean, it's another dollar I don't get to invest or reinvest in my business, my life, my retirement, all of those things. I know we're coming up on time here, but I'm like super curious. Like, where do we get going with this? If I'm a business owner, say of maybe it's just myself, I'm a solopreneur, or maybe there's like 5, 10 people in my business. Like, how do I get going on this?
Yeah, let's use the solopreneur example, and we'll try to wrap this up in about a minute. The first thing is you would work with us because we would figure out your funding level. That's the first. How big or small can I design this plan? We would design the bookends, right? And it's not a simple formula. I mean, it is a formula. It's not as simple as a 401k where you have your max and you're done, right? This is based on income and age. And so as you create more wealth, you can actually deduct more. This grows with you. So that's step one. Step two is plan, design, and customization, which we would work with you on. We pride ourselves on our service. We would actually design a customized plan for you, which would include, like we just talked about, Mark was a great point of what assets we would put in it. How would we design the plan? The third part, and by the way, we're almost 75% done with how to implement this, and I'll get it done in 30 seconds, is we would hire a TPA, a third-party administrator. Almost everybody who participates in a 401k is familiar with a TPA. It's the website you go to pick your asset allocation, right? Whether it's a behemoth like Voya or a boutique company that you're working with, you would work on the TPA. We would work with assign a TPA to it, and they would handle the day-to-day administration. Why is this important, Mark? We're running small businesses. We don't have time for this. This is largely turnkey. We help you on the front end, determine the amounts and the design, and then a TPA, third-party administrator, executes it. And finally, that third-party administrator works with us and your CPA to make sure the deductions show up in the right place on your tax returns each year. And now you're just smiling because you're paying less in taxes and the asset side of your balance sheet is going up. That's it. That's implementation, Mark.
I love that, Ro. I mean, that's kind of where my head was going, right? Like, as I watch all of this, how do I make sure that this lift isn't going to come at the distraction of me executing my business, right? So I think you brought us home. So to kind of recap, I think I heard a couple of things. One, with a cash balance plan, we're looking at we'll call it acute higher contributions, significantly higher contributions than a 401k, which turn into some pretty, frankly, sexy pre-tax implications to my business, some significant deductions, right? The output of this, the exit of this gives me, assets that grow over time that become incredibly valuable to me, specifically the business owner. And I guess if I were to line like an overall like marquee to our discussion, I'm thinking a lot about like instead of being reactive to my tax situation, I'm now becoming the owner or taking control of what it means to be a business owner, my taxes, so that I can direct my own future.
Yeah, and you should reserve the right to be the last word guy, but the words you just said was fantastic. I get to be the owner of this, right? We called it the owner's asset because life insurance and cash balance plans and the intersection of the two is about dominion and ownership, controlling your taxes. Because I think you said it. If you don't pick how much or have a say in your taxes, someone else is going to have a say for you. You own part of the company when it's a mutual company. You own your tax outcome. You own the cash flow around it. So yeah, we find this intersection to be very interesting.
Thanks, Ro. Appreciate your time.
Have a good one.